Silver is the only market I know where the shortage keeps getting worse and the price keeps standing perfectly still. The metal is disappearing from the world's vaults. The mines cannot pull it out of the ground fast enough. And yet, every time it gathers itself to move, some invisible hand seems to reach down and press it flat again. If you own silver, you have felt this. You have watched gold climb toward the record books, while the metal in your hand sits there like it is nailed to the floor. And you have wondered, quietly, whether you are the fool in the room. You are not. And I am going to tell you the real reason right now, in plain words, because the whole point of this channel is to say the thing the big desks would rather you never think about too hard. The reason silver refuses to run is not that nobody wants it. It is that a small handful of very large banks hold enormous short positions against it on the futures exchange we call COMEX, and that mountain of paper acts like a lid welded onto a boiling pot. The physical metal underneath is getting tighter every single year. The paper on top keeps the price from showing it. That gap between what the metal is doing and what the price is allowed to do is the entire story, and once you see it, you cannot unsee it. Let me give you the one fact that opens the door. The world has now run a structural deficit in silver for several years running. That means every year, more silver gets used up than gets dug out of the earth, and the difference gets covered by draining the piles of metal that were sitting in vaults from years past. That is not a forecast. That is not a theory some newsletter is selling you. It is the plain arithmetic of a market that is quietly eating its own reserves to keep the lights on. In any normal commodity on Earth, a shortage that deep and that persistent sends the price climbing until demand backs off. In silver, it has not. And the question every honest person should be asking is, why not? Here is why not. Silver does not trade the way you think it trades. When you picture the silver price, you probably picture supply and demand for real metal meeting in the middle. But the price you see quoted is set mostly in the paper market, in contracts, in promises to deliver metal that, in the overwhelming majority of cases, never actually gets delivered. Far, far more paper silver changes hands every day than there is deliverable metal to back it. And a small group of the biggest banks on Wall Street sit at the center of that paper market, with a very large, very concentrated bet that the price will go down, or at the very least stay put. Think about what that does. When a lot of real buyers show up wanting silver, in a free market, the price has to rise to find a seller. But if a handful of enormous players can simply write more paper contracts out of thin air, they can meet that buying pressure with a wall of new promises instead of scarce metal. The buying gets absorbed. The price barely moves. The shortage in the real world gets worse, and the number on the screen just sits there, calm as a mill pond. That is not a conspiracy theory. That is the mechanical result of a market where paper claims dwarf the physical metal, and where the paper is concentrated in a few hands with a strong interest in the price behaving itself. Now, I have been in the gold and silver world a long time, and I want to be honest with you about something, because honesty is the only thing that makes the rest of this worth listening to. I cannot tell you the exact size of those positions on any given day, and I would not insult you by pretending I can read the mind of a trading desk. What I can tell you is the pattern, because I have watched it play out more than once. When the price of silver starts to get away from them and climb hard, something strange has a way of happening. The exchange raises the cost of holding a position, the margin, sometimes several times in a matter of days. Suddenly, the smaller speculators who were riding the move up cannot afford to hold on. They are forced to sell. The rally that looked so strong buckles and collapses, and it collapses even though not one thing changed about the actual supply of silver in the world. I have seen that exact movie. Years ago, silver went on a tremendous run and got right up near a ceiling it had only touched once before in modern history. And then, in a matter of days, the rules got changed underneath it. The cost of holding the position was jacked up again and again in quick succession, and the price fell by roughly a third in about a week. Nothing fundamental had shifted. No mine flooded the market. No factory stopped buying. The shortage was every bit as real the week after as the week before. What changed was the plumbing, the mechanics of the paper market, and that was enough to break the back of the move. If you were a machinist who had put a chunk of his savings into silver because he understood, from a lifetime of working with real materials, that the stuff was genuinely scarce, you got taken to the woodshed by something that had nothing to do with whether you were right. And that is the cruelty of this market, and it is exactly why so many good, sensible people give up on silver right before the thing they were waiting for finally happens. They are right about the metal. They are just not accounting for the lid. They keep looking at the shortage and thinking, this has to break loose, and then the paper market slaps it down again, and eventually they decide they must have been wrong, and they sell. They sell to the very institutions that engineered their discouragement. If your stomach has knotted up watching this, if you have felt like a sucker for holding, I want you to hear me clearly. The feeling is manufactured. It is a feature of how this market is built, not evidence that you misjudged the metal. So let me pull this up to where you live, because this is not an academic puzzle. This is about your retirement, your savings, the years of work sitting in your accounts. Here is one of the most useful things I can hand you, and it comes straight out of everything I just described. Because silver has been held down by that paper lid while gold has been allowed to climb toward record territory, the relationship between the two metals has stretched to one of the widest, most lopsided readings you will find in modern history. It takes an enormous number of ounces of silver to buy a single ounce of gold right now, far more than the long-run average, far more than the ratio the two metals traded at for most of the last century. In plain English, silver is deeply, unusually cheap compared to gold. And every time in the past that this gap has stretched this far, it has eventually snapped back, and when it snapped, silver did not crawl. It ran. Now, here is the part almost nobody tells retirees, and it is why I put together something I want to give you. You can act on this stretched relationship inside the retirement account you already have, without paying taxes or penalties to do it, and without becoming some kind of insider. This is the free Retirement Wealth Protection Guide. And it is exactly what it sounds like, a plain-spoken guide for American retirees with $100,000 or more in a 401k or an IRA, showing you how folks are moving a portion of that money into physical gold and silver inside a self-directed account, the kind you can actually hold. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. It is free, from our family to yours, no obligation, and nothing to buy. And let me be clear about who this is for. This is not just for the insiders and the big players. If you have $100,000 or more in any retirement account, this is for you. All right, let me get back into it, because I told you the lid was the reason, and now I have to show you why the lid cannot hold forever. And this is where it gets genuinely interesting, because a paper cap on a price only works as long as the metal underneath is available to nervously wave around. The moment the real metal runs short, the game changes completely, and the metal is running short. Start with where silver comes from, because this is the piece that traps the whole system. Most of the silver mined on this planet does not come from silver mines. It comes out of the ground as a byproduct of digging for copper and lead and zinc. That means the amount of silver the world produces is chained to how much of those other metals people want. When the price of silver rises, the miners cannot simply flip a switch and produce more, because they are not primarily silver miners. They are copper miners who happen to get some silver on the side. So the one release valve that every other commodity has, higher price brings more supply, is mostly broken for silver. The shortage cannot be fixed quickly no matter what the price does. Now stack the demand side on top of that. A huge and growing share of silver gets consumed by industry, and by consumed I mean truly used up, spread in tiny amounts across solar panels and electronics and the enormous electrical build-out happening across the modern economy. There are only a few grams of silver in a solar panel, but there are a great many solar panels, and once that silver is dispersed across a rooftop in the desert, it is gone. It is not economic to recover. This is the old saying that has held true for generations. Gold is hoarded, but silver is burned. Nearly all the gold ever mined still sits somewhere in a vault or a drawer or around someone's neck. A great deal of the silver ever mined has been scattered and destroyed in the act of using it. Every year that goes by, more of the world's silver is quietly consumed and cannot come back. So follow the logic all the way through. Supply that cannot ramp up because it is a byproduct. Demand that keeps rising and physically destroys the metal. A deficit that has run for years and is draining the vaults. And then, sitting on top of all that real-world tightness, a paper market where a few banks can print promises to keep the price calm. You do not have to be a genius to see that this is a bridge with a growing crack in it. The reported deliverable inventories at the exchange have been drawn down. The free-floating metal in the big London vaults has been pulled lower. And critically, the metal is being pulled east, hard, toward China, where the domestic price has traded at a persistent premium to the West, which is the market's way of screaming that real metal is worth more over there than the Western paper price admits. Here is where it gets strange, and this is the part Warren most want you to sit with. A price cap made of paper is only as strong as people's willingness to accept paper instead of metal. As long as everybody who trades silver is happy to settle their contracts in cash, to roll them over, to take the promise instead of the bar, the lid holds, and the few big shorts sleep fine at night. But the instant enough buyers start saying, "No, thank you, I do not want your paper, I want the actual metal delivered to me," the whole arrangement is in danger. Because there is not nearly enough deliverable metal to satisfy all the paper claims, if even a modest fraction of them demand the real thing at once. The lid is not made of steel, it is made of trust. And trust in a system like that can hold for years. Right up until the afternoon, it does not. I want to be square with you about the risks here, because that honest caution beat is the whole difference between me and a hype channel, and it is the reason you should trust anything else I have said. The banks and the exchanges are powerful, and they have kept this game running for a very long time. They can keep it running longer than you might think possible. A lid like this can stay clamped down for years while you wait, and if you buy silver expecting it to break loose next month, you may be sorely tested. I cannot promise you a price, and I cannot promise you a timeline, and anyone who does is lying to you. This is a case built on real, durable facts about how the market is structured. It is not a guarantee, and it is not personal financial advice. What I am giving you is the mechanism, honestly, so you can decide for yourself with your eyes open. There is also a real question of what could accelerate it, and here is where I have watched the ground shift under the whole financial world in recent years. Look at what the central banks are quietly doing. For 3 straight years now, they have been buying gold at a pace not seen in generations, roughly double what they were buying a decade ago. And gold has climbed so far that it has overtaken other major assets to become one of the largest reserves those central banks hold. Why would they do that? Because they learned a hard lesson recently, when one major power had its reserves frozen overnight in a conflict, and every other central bank on Earth suddenly understood that money held in someone else's system can be switched off, but metal sitting in your own vault cannot be frozen and answers to no one's politics. The smart money is voting with its feet, out of paper promises and into hard metal. They are doing it for gold in the open. The same logic points straight at silver, which is far smaller, far cheaper, and far tighter. And that brings me to the thing I most want you to understand before we finish, because it is the whole reason timing matters. The people who run this world's money are already positioned. The central banks are already buying. The largest, most sophisticated players already understand exactly what I have laid out for you tonight, that the paper lid is a temporary arrangement sitting on top of a genuine and worsening shortage. What has not happened yet is the moment the ordinary crowd figures it out. The pension funds have not moved. The financial channels are not talking about it. Your neighbor is not asking you about silver at the barbecue. And that is precisely the window that matters. Because once this becomes the story on every screen and every advisor is finally recommending it, the discount you can buy today will already be gone. The whole advantage lives in understanding it while it is still boring, while it still feels like nothing is happening. By the time it feels obvious, the cheap part is over. Being early does not feel exciting. It feels like patience. That is the cost of admission. So let me leave you with what to actually do about your own position. Honestly, as principles and not a prescription. Own the real metal, not just a paper claim on it, because in the world I have described, the difference between holding a bar and holding a promise could turn out to be everything. Size it so that a shakeout, one of those manufactured drops in the price, can never force you to sell at the bottom, into the hands of the people who engineered it. Do not chase and do not panic. And whatever you do, do not let a lid made of paper convince you that you are wrong about the metal underneath it, because the shortage is real and the lid is not permanent. Which brings me to the last thing, and then I will let you go. If everything I have laid out tonight makes sense to you, if you can feel the difference between a market that is genuinely oversupplied and one that is simply being held down while it quietly tightens, then take the next honest step and get the free Retirement Wealth Protection Guide. This one is not only about protecting what you built, it is about the legacy, about diversifying a portion of what you spent a lifetime earning so that a piece of it passes to your children and your grandchildren in a form that no bank and no printing press can quietly dilute. And for those of you with 100,000 or more in your retirement accounts, if you have watched all the way to the end here and you mention that you did, we will set up a free one-on-one educational web conference just to walk you through how this actually works for your situation. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to readfamilyguide.com. From our family to yours. And here is the honest why now, with no fake deadline attached. The moment to make a calm, reversible decision like this is exactly when it does not feel urgent, when the price is still asleep and the crowd is still looking the other way, because that quiet window is the one thing they can never sell back to you once it closes. So the next time you look at silver sitting there, refusing to run while the shortage screams underneath it, I want you to remember that machinist who understood scarcity in his bones and got shaken out anyway. He was not wrong about the metal. He just did not know about the lid. Now you do. The pot is still boiling. The physical is still tightening. And a cap made of paper and trust holds only until enough people stop accepting paper. That is the real reason silver refuses to run. And it is also the reason that someday it may not be able to be held down any longer.